It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. As the summer season is upon us, we're navigating a turbulent few months for the airline industry with the Goodbye or Goodbye scorecard. Yes, for the first time ever, we're taking a look back at a call that a guest has made to see how it's done. And so let me bring in Steve Trent, Citi Airlines analyst. Steve, thanks for being here. So at the beginning of the year, you said your goodbye, the stock you liked, was Delta, and you said to avoid JetBlue. So big reveal, let's see how you did. You did pretty darn good. Delta is up about 25% year to date, and JetBlue has fallen about 1% or so for the year to date, including today. So your call worked out pretty well, but you're sticking with it. You say this is still a good call to have, and you still like Delta here, right?
Yes, absolutely. I think we're in the early innings of this.
Okay, so let's go through why. You talked about wallet share gains for network airlines. So what do you mean by network? Network versus discount, I assume.
Absolutely. So if you bifurcate the U.S. airlines between the full service carriers on Delta's side and the discount airlines, the JetBlues on the other side of the fence, you've actually seen a big pickup. Pre-pandemic, if you look at the earnings wallet share, the network airlines had roughly 75% of the pie. On our numbers, 2024, 2025, they have closer to 92, 93% of the pie. So we've seen these post-pandemic shifts in work. Most people are no longer in the office 5 days a week, so that fly out Sunday night, fly home Thursday night, it's not totally gone, but it's diminished. And I think that shift has led to hybrid travel, which has really benefited the network airlines.
Interesting. And also what we've seen is maybe more economic activity per available seat mile. So wringing more profit out of those seats at Delta. How are they doing that?
Absolutely. So the first issue you have, not only are they taking higher share, but we also continue to have a paucity of capacity on a per capita basis. So if we go back to 2019, there was a little less than $24 of economic activity per available seat mile in the U.S. domestic market. Last year, that was above $29. This year, we think it's going to be above $30. These global aerospace supply chain issues are not going away. So at the same time, network airlines are picking up more wallet share. The wallet opportunity itself is getting bigger from that dearth of capacity we have out there, and they're going to be able to price more effectively that scarce capacity than a discount airline.
It sounds like that means prices are going up for us.
Probably.
For you. Okay. And then finally, there are the co-branded cards that they have and the money that Delta gets from that. And that's going well, I guess.
It's going extremely well. And I would say Delta really has the best brand of a U.S. airline, and they've spent years developing that very good brand. And that's everything from being the very last airline to unblock the middle seat at the height of the pandemic, to the only major that did not dilute its equity holders with convertible debt or equity offerings during the pandemic, with a very small number of warrants that got issued to the Treasury Department because of the CARES Act. So when we think about that counterparty profile, a big global loyalty program, they're making very good revenue off of that. So we think that trend is going to continue, as well as be a really important distinguishing factor between the network and the discount airlines.
So let's talk about what could potentially go wrong for a Delta. We could see a regulatory crackdown. What would that look like, and what effect would that have?
Sure, absolutely. So you've seen little wisp of this already. Slightly trickier rules for the airlines in terms of being required to pay refunds to consumers after there's a certain number of hours of delays, stricter rules on compensation for checked bags. Does that get more intense for the group? I think it's hard to say, but do we get something more extreme that will limit co-branded card activity, limit loyalty program activity, I'm not saying it's going to happen, but this is kind of the wild card one would worry about in this case.
Gotcha. All right, so let's get to JetBlue now, and your goodbye, the stock you don't like. As we mentioned, the stock has not done terribly well here, and you say it doesn't have its revenue verticals thriving. What does that mean?
Yeah, absolutely. So when we think about that fantastic loyalty program you have with a Delta or a United Airlines, for example, it's really tough for the discount airlines to have that same level of punch. So a large financial institution as the partner loves the big programs for the relatively wealthy consumers. They can cross-sell all day long. You know, a discount airline doesn't have that. It doesn't have the global capillarity. JetBlue has a very good Mint product, and they do some of that transatlantic, which is great, but that's a very small piece of the pie. So there's no trans-Pacific. They do not have a robust co-branded card program like the others do. They're largely domestic. You know, Mexican beaches, there's overcapacity now. Caribbean, there's some overcapacity. So they're in a tougher spot.
Gotcha. And then, of course, there's the big event that didn't happen with the company, right? They were going to get together with Spirit, excuse me. That fell apart. So now what is kind of the question?
Absolutely, and it's a tough one. So if you're JetBlue, in that case, you wanted scale. You wanted to jump to be the number 5 position in the group. And it also sort of reminds me of what we saw years ago with Southwest Airlines acquiring AirTran. Southwest needed the pilots and they needed the equipment, and they got both. JetBlue seemed like it wanted to do the same. The regulator said no. So we have the pilot and equipment issue. We have the geared turbofan engine issue potentially making some hiccups here in capacity growth. So it kind of begs the question, strategically, what do they do? I think it's a tough thing to make heads or tails of after that merger got blocked.
Yeah, and then that leads to the idea that there's not a way back to sustainable margins when you have those kinds of headwinds.
It's hard. So getting back as well to what I mentioned on the network airlines having that really big post-pandemic pickup in wallet share, you know, largely 2 network airlines. If you're JetBlue, on our numbers, it doesn't look like an easy path to get back to sustainable margins and earnings when you're in that situation. So there has to be some kind of course correct, you know, on your verticals or on your seat mile cost profile, and is not sure how either is going to get done.
Gotcha. And then what could go right for JetBlue? Well, they have new management, so they could come up with a plan maybe to address some of these issues.
Absolutely.
Yeah.
Look, they have a new CEO. She's terrific. She's going to do her thing. Strategically, are there surprises that we can see from them? Absolutely. You've got some Schedule 13D filings out there, some new people on their board. Do they have some wild cards to show the market? I don't necessarily see any, but that's always something that you've got to keep your eyes on.
Could happen. All right.
Absolutely.
And any position in either of these stocks?
Me neither.
Okay.
Yes.
All right. Well, you're sticking with it here, telling people buy Delta and avoid JetBlue. That's something that you've stuck with since January. So thanks for coming back, Steve. Good to see you again.
Thank you for having me. Appreciate it. That. Thank you.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.